Okay, good afternoon and welcome back everyone to our Thursday afternoon options education session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and we're here to talk about a very, very important topic, regardless of whether you're brand new to options trading or you're an experienced trader and you've been trading options for a while, specifically if you've been trading complex option strategies like vertical spreads, straddles, strangles, condors, butterflies, any of these complex option strategies. These are built on fundamental building blocks. And today we want to talk about those fundamental building blocks and making sure that you understand them in and out, the pros and cons to each one, because that is how you're going to be able to improve your options trading and better your understanding of more complex strategies. So with that, let's go ahead and get started. But before we do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the securities that we'll discuss here during today's session. So I'll start off with just the option contract basics. Now, like I said, whether you're brand new, this is a session for you because we're going to start from the very beginning, or if you're an experienced options trader, I guarantee you, even as experienced options traders, understanding the fundamentals better will help improve your options trading. So we'll look at the contract basics, which most of you should be familiar with, but for those of you that aren't, we'll do that refresher. We'll look at the four core strategies, which are buying calls and selling puts. These are the bullish strategies. Then we'll look at buying puts and selling calls, which are the bearish strategies. These are the fundamental building blocks of all complex strategies. If you can understand these four strategies, you should, in theory, be able to understand any 2, 3, 4 leg strategy that someone throws at you, or if even someone just creates a completely custom strategy. If you understand the fundamental building blocks, you will understand anything in more advanced that. Unfortunately, I do see a lot of investors jump into these complex strategies without really understanding the building blocks. And that's really where you can fall short on those complex strategies. Then we'll sum up what we learned here today and talk a little bit about what are the next steps once you understand these fundamental building blocks. And we'll try to go through a few examples here before we open this up for Q&A. So the primary question that I want to help investors walk away from today's session is a clear understanding as to what are the fundamental differences between buying versus selling calls. So before I get started, I just want to get a quick poll here from the audience. If you could please bring up your chat window at the bottom of your screen, and please type 1 into the chat window if you're learning how to trade options, and please type 2 into the chat window if you're currently already trading options. So 1 if you're learning, 2 if you're currently trading. Okay. A lot of 2s, but I also see a fair number of 1s. So for all of you that answered 1, this is really probably the most important lesson that you need to learn to get started with any type of option strategy. And for those of you that answered 2, I really hope that you take the time to learn these fundamental building blocks, and you don't and you're not using these as I already know the basics. I don't need to learn. It's really important that you take the time to learn these fundamentals. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to share with you what I believe are absolute necessities in order for you to improve your options trading. So let's first talk a little bit about option contract basics. So for those of you that answered your number 1, if you're just learning, at the end of the day, a contract is simply, an option is a contract between 2 parties. And the contract has effectively two sides. You can be a buyer or you can be a seller. And as the buyer of an option, it provides you with the right, but not the obligation to buy or sell an underlying asset. We're going to go through some examples to help you better understand what that actually means. But the contract also specifies a specific price at which you can buy or sell this specific underlying asset. And it also has an expiration date of which you need to exercise your right on or before this specific date. Now, if these 3 phrases is confusing to you, that's okay. This is effectively a legal language. And most of the time when we look at legal languages, things are not particularly easy to understand. So that's why we're going to break this down. And the most important thing to remember whenever we talk about an option contract is the fact that there is a buyer and there's a seller. There's always two parties to an option contract. The buyer is responsible for paying, and the seller will collect what the buyer pays. And the buyer effectively has the right to either buy or sell this asset at an agreed upon price before the expiration date. And the seller, in exchange for collecting the premium, has simply the obligation. What that means is that the buyer has the option to decide whether they want to buy or sell the specific asset at the agreed upon price on or before the expiration, but they don't have to. But if the buyer chooses to exercise that right, the seller has no choice but to take the opposite side of the transaction. So if a buyer pays for the right to buy a specific stock at agreed upon price on or before the expiration date, if that buyer chooses to exercise that right, the seller is obligated to effectively sell that security to the buyer. So again, this is a mouthful, and maybe it's the best way to learn is going through some examples, and that's exactly what we're going to do here today. But that in itself is largely what an option contract is referring to. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. And if it doesn't make sense for you, that's okay. We're going to go through some examples. So as a contract, as an option contract, there are 4 possibilities. You can either be the buyer of a contract or the seller of a contract. And you can be the buyer or seller of a call option or the buyer or seller of a put option. So again, a buyer always has the right to, a seller always has the obligation to. And when you buy a call option, that gives you the right to buy. A put option gives you the right to sell. So those are the 4 core strategies, and all option strategies are based on these 4 fundamental building blocks. Everything has to be built from one of these 4 strategies. And sometimes it's confusing to remember which one is which. So I think an easy way to kind of remember is to use some basic math. I have a positive for a buyer and a positive for a call because that is to buy. I have a negative for sell and a negative for puts because puts are to sell. So what you can do is you can do some basic math. If you're buying a call, that's a positive and a positive, that's going to give you a bullish strategy. On the flip side, if you were to sell a put option, that's a negative multiplied by a negative, which makes a positive. So selling a put is easy to remember as a bullish strategy. Now, if you were to buy a put, which is a positive and a negative, that's how you know it's a bearish strategy. And if you were to sell a call, that's also a negative and a positive. That's how you know it's a bearish strategy. So that's just a little trick that you can use if you're first time learning this, and this is a little overwhelming, to help you remember which one's bullish, which one's bearish. And today what we're going to do is we're going to dive into all 4 strategies and make sure you truly understand each strategy. What are the pros? What are the cons? What are the risks? What are the potential rewards to help you decide when you might want to utilize each one of these strategies. And what you're going to learn here today is that there's no such thing as a best strategy. Each strategy has their benefits and limitations or drawbacks, and it's just important that you understand what the benefits are, what the drawbacks are, so that you can understand when you want to deploy one strategy over the other. This is not a lesson in trying to say this strategy is better than another, because truly there aren't strategies that are better than the other. So let's go ahead and dive in. Once what we're going to do is we're going to talk about is buying a call option. This is a simple option strategy. This is usually one of the first option strategies that you will learn. And the one thing I will say about this strategy that attracts most investors to it is the risk to reward ratio. Because when you buy a call option, you have limited risk with unlimited reward. And just to clarify, buying a call, what that means is that you have the right to purchase the call at a specific price sometime in the future. So I'm going to use Delta Airlines as an example, currently trading at $41.35. So what I have here is the September 17th $41 call option. What that translates to is that the buyer has the right to purchase Delta Airlines at $41 a share anytime on or before September 17th, which is about 50 days from expiration. So over the next 50 days, the buyer has the right to purchase the stock at $41 anytime before September 17th. And the buyer in this particular case has to pay $2.50 or $2.50 per share. And remember, each contract represents 100 shares. So at $2.50 per share multiplied by that 100 shares, that is paying the seller $250 to enter into this contract. Does that make sense? Please type 4 into the chat window if that makes sense to you. And what we're going to discuss today is why would someone want to purchase a call option such as the one that I've shown you here today? So a few things to remember. Like I said, limited risk in exchange for unlimited reward. And we're going to discuss how that is even possible. How do you get limited risk with unlimited reward? So just to quantify a few things before we get into that, when you buy a call option, the most you can lose is what you pay. So if I pay $2.50 multiplied by 100 shares, to $250 is the most I can lose no matter what happens, even if Delta Airlines was to go back to zero. So I think the stock's going to go higher, but let's say for whatever reason, some really bad stuff happens in the travel industry and the stock goes bankrupt and the stock goes down to zero. Even if that were to happen, you're only risking $2.50 per share. In exchange, you have unlimited upside. If the stock keeps going higher and higher and higher, you can make more and more money. So why don't we just always buy call options? Why would we ever buy the stock? Why would we ever use any other strategy? Who doesn't want to have a limited risk in exchange for unlimited reward? Well, there's one drawback to this strategy, and it's the fact that the break-even price of this particular strategy is the strike price that of the call option that I'm purchasing, which here is $41, plus the $2.50, which is what I have to pay to enter the contract. And that gives me a break-even price of $43.50. So what we're going to do is we're going to look on the next slide why the stock has to reach $43.50 before this is profitable. What that means is that I have to actually believe the stock is going to exceed $43.50 before I make a single penny. What that means is that the stock can actually move higher. Maybe it moves to 42.5, 42.75, 43. And even if that moves in the directional view that I have, which is a bullish view, I can still lose money on that trade. And that is the drawback that you have here with buying a call option. So just to show you what that looks like, this is a chart of Delta Airlines. This is the line for 43.50. What that means is that if I buy this call option and the stock moves higher, but let's say it doesn't move up to 43.50, it moves only up to 42.50. This strategy is still unprofitable. Why is that the case? Because as a buyer, what I'm doing is I'm paying $2.50 for the right to buy Delta Airlines at $41. So let's look at this. Let's say by September, the stock is at $42.50 and not yet at $43.50. Let's say it only reaches $42.50. So what does that mean? Is I have the right to buy the stock at $41 when it's currently valued at $42.50. Well, if I can buy it at 41 and immediately sell it on the open market for $42.50, I make $1.50. That sounds great, right? But remember, I paid $2.50 to get into the contract. So if I can make $1.50 on the trade, but I already paid $2.50 initially to get into the trade, what is my net profit at the end of the trade? The answer is I lose $100. So that's why if I buy a call option and the stock moves a little bit higher, guess what? I'm not profitable. Only if the stock exceeds $43.50, which allows me to buy the stock at 41, sell it at 43.50. That makes me $2.50 in profits. That in itself is only going to offset what I paid to get into the contract. So even if the stock was to rally to $43.50, I'm not even profitable. I'm just breaking even. So only if the stock was to rally beyond $43.50. Let's say it gets up to 45. Now I can buy the stock at 41, sell it on the open market for 45. That's a net profit of $4 minus the $2.50 that I paid for the contract. Now my net profit on that is about $1.50. So remember, I risked $2.50 to make $1.50 if the stock reaches $45. Now, for the stock to rally from 41 to 45, that's about an 8% moved in the underlying stock just for me to make $1.50 while I risk $2.50. As you can see, it's not every single day that you find stocks that you think is going to rally this much in a short amount of time. So that's the drawback that you have when you buy a call option. So sounds very attractive. I have limited risk in exchange for unlimited reward. And that's true, right? If the stock was to reach 52.5, well, guess what? I can buy the stock at 41, sell it for 52.5, and all I have to do is subtract $2.50. So the higher the stock goes, the more money I can potentially make. While as long as the stock is down here, guess what? I just leave my call option I basically let it expire worthless. And the only thing I have to lose is the $2.50 that I paid for it, because there's no chance that I'm going to buy the stock at 41 when the stock is down at 35, right? Why would I pay $41 when I can just buy it on the open market for 35? So that's why my call option would simply expire worthless. And that's how we get this risk profile of risking only $2.50 in exchange for unlimited upside. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. Okay, so that's the thought process behind buying a call option. Limited risk in exchange for unlimited reward, but you need the stock to make a big move before that strategy is really worth your while. That's the drawback that you have with buying call options. So flip side, let's look at selling a put option, which is the other bullish strategy. And this is really one that on paper, a lot of investors, especially first-time investors, when they look at the strategy, they stay far, far away from it, because this is a strategy that has, in exchange, substantial reward in exchange for substantial risk in exchange for limited reward. What that means is that the most you can make is limited, while the most you can lose is fairly substantial. So let's look at this real quick. So in this particular case, when I sell a put option, my max risk is actually $38.89 or $3,389 on Delta Airlines. Or actually, let's back up 1 second. Let's say I was to sell the September $41 puts. Okay. What that means is that I am a seller, meaning I have the obligation as a put seller. So someone who's buying this put has the right to sell the stock, which means that as a put seller, I have the obligation to buy the stock. So on September 17th, I have the obligation to buy the stock at $41 if the buyer of the put option chooses to exercise their right to sell, to exercise their put, which is to sell their stock to me. And when they sell their stock to me, I'm forced to buy it. But in this particular case, because I'm the seller of the option, before the buyer of the option had to pay that premium. Now, as a seller of the option, I get paid that premium. So remember, I have the obligation to buy the stock at 41, and what I'm collecting here is $2.11 or $211 per contract. So when you look at a short put, my maximum reward is $211 or the $2.11 per share. My max risk is $3,389. And a lot of investors look at this and they'll say, why would anyone in the right mind would ever risk $3,400 in exchange for trying to make $211? Well, first of all, this, in my opinion, is not a fair, even though it is 100% true, it's not such a fair representation from the perspective of, in order for you to risk $3,389, the stock, Delta Airlines, by September 17th has to go to zero in order for that to happen. Even if the stock were to decline to 38 or 35, you can see that the risk is substantially less than the $3,389. So even though technically max risk is true, the stock would have to go to zero in order for that to happen. But as you start to learn about these types of strategies, you realize that there is a flip side to this. Just like how on the call option, there was a flip side to that, what looked like very attractive risk to reward. Now you have this very unattractive risk to reward, but there's a flip side to it. There is a benefit to this you would call it negative risk reward ratio. And that's the fact that selling a put is a bullish strategy. And before, the stock had to move by a certain amount before the strategy is profitable. Well, now when you sell a put option, not only does the stock not have to move so much in order for you to be profitable, even if the stock was to move against you, you can still be profitable. It's a very forgiving strategy. So the break-even price is actually your strike minus your premium price. This is a typo, I apologize. It's $41 minus $2. Whoops. $41 minus $2.11, which is $38.89. So we think Delta Airlines is going to move higher here. But as long as the stock stays above $38.89, I'm going to be profitable. What that means is that even if the stock was to trade sideways, or even if it's move a little bit lower, I can still be profitable. It's what we call a very forgiving strategy. So in this particular case, the best way to illustrate this is to look at the stock. So this is the exact same chart as we looked at before. And before we saw that we needed the stock to make a big move to the upside in order to be profitable. But when you sell a put option, yes, when the stock makes a big move, you are profitable. But if the stock moves sideways, you are also equally profitable. And if the stock moves a little bit lower, you're still going to be profitable. Only if the stock was to decline below the $38.89 do you actually lose money on the trade. So let's just review this, right? Because as a put seller, you collected $2.11 for the obligation to buy the stock at $41. What does that mean? If the stock is at $42.50, guess what? The put buyer will never exercise their put, because why would they sell to you at $41 when they can sell it on the open market for $42.50? So if the stock is above the strike price, this put option will expire worthless. But let's say the stock is down to $40, right? Let's say you think the stock's going to go higher, but the stock instead goes lower. What happens is that, yes, now you're obligated to buy the stock at $41 that is only worth $40 on the open market. So if you were to buy at 40 and sell on the open market, you would lose $1 on that transaction. But you were paid $2.11 to get into the transaction. So if you lose $1, but you got paid $2.11 to enter it, you're still net up $1.11. That's why even if the trade goes against you, you have a $2.11 buffer against that move. So that's what's forgiving, if you will, about the short put. If the stock was to rally, you make money on this trade because the put option expires worthless and you keep your $2.11. If it trades sideways, it also expires worthless and you keep your $2.11. If it starts to decline, you have a buffer that prevents you from losing money until the stock drops below $38.89. At $38.89, what you're forced to do now is buy the stock at 41 that you have to sell at $38.89, which would be a loss of $2.11, which is 100% cushioned by the $2.11 that you collected to get into the trade. Only if the stock was to significantly fall. If it falls further and further and further, what happens is you're still forced to buy at 41, but then you have to sell it on the open market for a lower and lower price. And the lower it goes, the only thing that you have to offset that loss is only that $2.11. And that's why when you sell a put option, you have this negative risk reward ratio where you have limited gains, the $2.11, in exchange for unlimited losses to the downside all the way down to zero. Does that make sense? Please type 6 into the chat window if that makes sense to you. Now, at this point, if you're following along, great. If you feel a little overwhelmed by these numbers, that's okay. That's why we record these sessions with these slides so that you can follow along. But the OptionsPlay platform, the platform that you have access to, calculates these things for you, calculates your max risk, calculates your break-even price, shows it to you on your chart so that you can quickly see how far does a stock need to go in order to be profitable, how far does a stock need to go down before I lose a certain amount of money. This is all designed so that you can have not only access to the education, but also the tools to help you implement and explore these types of strategies. So next, what I want to look at are two bearish strategies. Now, if you understood the first two, the second two are going to be easy to understand because they're just mirror images of each other. If you felt that the first two was a bit of a struggle, hopefully this helps you just understand this a little bit more. So let's look at buying a put option. So this is a September 17th, $42 put. What that means is that as a put buyer, you have the right to sell the stock at $42 sometime on or before September 17th. And as the buyer, you have to pay to get into this contract. You have to pay to have the option to sell the stock at $42. In this particular case, you paid $2.59 or $259 per contract. A put option, just like a call option, has limited risk. And instead of having unlimited reward, because when you buy a call option, there's no limit as to how far the stock can go, but there is a limit as to how much lower a stock can go. A stock cannot go below zero. So that's why technically it has limited risk and substantial reward rather than unlimited reward. But again, you still can, the stock can go to zero between now and that expiration date. You have a substantial amount of potential gains. So the max risk, as you can see, is the premium that I pay for the put option, which is $2.59. My max reward is $39.41, which is the strike price minus the premium. So this is a typo. It should be $3,941 is your max reward. So my break-even point here is $39.41. The stock is at $41.35. So you have to see that the stock has to decline by about 4 or 5% before the strategy is profitable. And you have the same problem. I shouldn't call that a problem. You have the same challenge, if you will, as buying a call option, which is the fact that the premium that you pay, you have to overcome that in terms of the stock moving lower by that amount before you can make a profit. And that's the challenge that you have with buying a call and buying a put, is that the stock has to move a substantial amount in the direction that you expect it to just to break even. And then you have to exceed that amount in order to be profitable. So let's look at the put option here. So the buyer here paid $2.59 for the right to sell at $42. So if, let's say, the stock is currently at $41.35 and the stock was to decline to, let's say, $40, let's say decline to $40. What that means is that I can sell the stock at $42 that I can buy on the open market for $40. So imagine being able to buy a stock for $40 and instantly selling it for $42. That gives you a profit of $2. But remember, you paid $2.59 to get into the trade. So on that particular trade, you made $2 on the transaction, but you lost $2.59 to get into the transaction. So your net loss here is 59 cents. And that's why buying a put option, even if the stock goes in the direction that you expect it to, but if it doesn't go far enough, you're still going to lose money on that transaction. And if anyone can relate to that, have you ever bought a call option or a put option where the stock went in the direction that you expected it to go, but you still lost money on that trade? Please type yes into the chat window if you've ever experienced that. I would say that that's probably one of the more disheartening lessons that investors for options have to learn. Buying a call option, you learn that it's bullish, and then you see that the stock is moving in the direction that you expected to, and then you realize that you still lost money because you never overcame the break-even point. That is the hardest lesson to learn, but once you learn it, it will become a lot easier for you to understand, should I buy a call option? Because the first thing you have to recognize is, what is the break-even point? The break-even point is calculated for you using our platform. And then what you really have to ask yourself is not, am I bearish on Delta Airlines? But the question is, do I think the stock is going to be below the break-even point? And your break-even point depends on the the cost of the option. These are a lot of other factors involved in here, but you really should be asking yourself, not am I bullish on the stock or bearish on the stock, but how bearish am I on the stock? Do I think the stock's going to be below $39.42? Do I think it's going to revisit this recent sell-off and maybe get back down to $37.50? If you think it's going to get down to $37.50, great. That makes sense because you can buy the stock for 37, sell it for 42. That's a profit of about $4.50, and you only paid $2.59 to get into the trade. So if you make $4.50 while subtracting $2.59, that's a profitable scenario. And the lower the stock goes, the more money you can make, because if you can buy it for 35, sell it for 42, that's $7 profit. All you have to do is subtract the $2.59 that you paid. That's why a put option has limited losses to $2.59, and you have unlimited profits to the downside all the way down to zero if you were to buy a put. Does that make sense? Please type 7 into the chat window if that makes sense to you. Perfect. Okay. So like I said, this pattern should start to make a little bit more sense as you learn a long call and a long put. And then what we're going to do is we're going to lastly look at a short call. Very similar to the short put, just the opposite in terms of a mirror image. So here I'm going to sell a September $42 call option. And just like previously for $1.99 or $199 a contract, remember, as the seller of an option, I have the obligation to do what the buyer of that option has the right to do. So the buyer of a call has the right to buy, which means that as a call seller, I have the obligation to sell. So when I sell a call option, I have the obligation to sell the stock at 42 sometime on or before September 17th. And I got paid $199 to take on that obligation. Now, this strategy is, in my opinion, the one that investors should generally avoid. And the reason for this is because you truly have unlimited risk. So many of you have seen what happened in the markets with some of the hedge funds that were short stocks like GameStop and AMC. The risk to the upside is unlimited. If the stock keeps going higher and higher and higher, you will lose more and more money. And a short call is at risk, the same risk that you have as shorting the stock. But this is an important building block. This is not to say that you should ever trade the strategy. And maybe some scenarios you might trade the strategy, and there are ways that you can trade the strategy where it's a hedged trade so you don't have unlimited risk. So those are some of the things that you want to explore next. But today we're just talking about the fundamental building blocks. We're not necessarily saying that these are strategies that you should trade, but it's important that you understand how selling a call option works. So like I said, you have unlimited risk in exchange for limited reward, just like selling a put option. So in this particular case, if I'm collecting $1.99 or $199 a contract, that is my max reward. I cannot make more than $199 per contract. At the same time, I'm taking on unlimited risk. And again, not a great risk reward ratio in the long run to take that type of strategy. But your break-even price is your strike plus your premium. Now, just like before, what I'm collecting acts as a buffer so that if the trade goes in my favor, I make money. But if the trade goes against me, I have this buffer that I can use to offset some of my losses. So in the example here for Delta, as a short caller, I have the obligation to sell the stock at $42. The obligation to sell the stock at $42. So if, let's say, the stock was to rally to, let's say, 42.5, right? So what happens is that I'm obligated to sell the stock at 42 that I have to buy at 42.5. So if I have to buy something at 42.5 and I have to sell it at 42, that's a loss of 50 cents. But remember, I got paid $1.99 to get into the contract, right? So if I have something that I paid that I got paid $1.99 for, and I have to buy at 42.5 and sell at 42, that's a loss of 50 cents. But remember, I got paid $1.99 for it, so I'm actually in the red. That's why, even though I'm bearish on this particular trade, If it goes lower, I keep my $1.99. If it trades sideways, I keep my $1.99. If it goes a little bit higher, I have that buffer. So that's really where selling options will give you that buffer that you simply don't get when you have to buy an option. But if the stock starts to move higher substantially, let's say it moves up to 50, now I have to buy the stock at 50 to sell it to the buyer at 42. Whoops, that's a loss of $8. And the only thing that I have to offset my loss for $8 is this $1.99 that I've collected. So the higher the stock goes, the larger my losses are. And the only thing I have to buffer those losses is that $1.99 that I've paid, or that I was collected on that particular trade. And that's why when you short a call option, when you sell a short call option, you have unlimited losses if the stock keeps going higher and higher and higher in exchange for this $1.99 or the roughly $2 or $200 that you're collecting on this particular trade. Does that make sense? Please type 8 into the chat window if that makes sense to you. So I know I went over a lot of numbers. I know I went over a lot of concepts. And for those of you that are thinking about buying and selling rights and obligations, this is a lot to learn. It absolutely is if this is your first time looking at this. Hopefully for those of you that have a little bit more experience, these are things that are concepts that you're understanding. And if you don't, that's okay. We record these so that you can watch them at your own pace. We provide you with these slides so that you can follow along your own pace. And I try to use real examples of stocks that you may actually follow in the markets to hopefully make the connection a little bit easier. But the OptionsPlay platform is designed to help do these calculations for you so that you can easily use the OptionsPlay platform and compare two strategies side by side. You can use our strategy constructor. You can select bullish strategies, and you can put the two strategies side by side and look at buying a call versus selling a put. And you can use our P&L simulator to actually simulate what happens if the stock was to rise. How much money do I make or lose on each strategy? If the markets were to go against me, how much money do I risk? If the market stays flat, what is my potential risk reward? That is how you can learn. And our platform actually is designed to show you all of these metrics that we talked about here today. Max risk, max reward. For those of you that are interested, probability of profit, your break-even point. So a lot of times, especially when you're first starting, there's a lot of numbers and you're confused as to how to calculate all of these numbers. We understand that. That's why we created this platform, so that all of these numbers are calculated for you. You don't have to do any of the math, and you really have to just think about, well, how far do I think Delta Airlines will rally between now and September? And you can plug those numbers in and see, oh, if I bought a call option, I'm looking at $255 profit versus $210 profit. And then always think to yourself, what if I'm wrong? What if the stock declines down to $40 instead? How much do I have to risk? Here I make $110. Here I lose $245. That starts to give you an understanding of that buffer that you get, right? So when you buy a call option, if the trade goes against you, you lose 100%. When you sell a put option and the trade goes against you, you have a buffer. So even though I got the directional view wrong, I have a buffer that I can still make a profit despite the fact that I've made the wrong directional view with a short put. And then what happens if the stock keeps moving lower and lower and lower? You can start to learn that the short put has a lot more to potentially lose than a long call, which only has $245. So the platform is designed to really help you learn and explore and try out different strategies and make sure you truly understand how much you can potentially lose, how much you can potentially make before you execute any strategy. Even if you're trading more complex strategies like a debit spread, being able to compare them side by side with buying a call option or a put spread or anything like that, this is designed to allow you to do that quickly using the OptionsPlay platform. So, just to summarize everything that we discussed here today, it's important that we don't think of these strategies as good or bad, because there's really no such thing as a good or bad strategy. It's all about understanding the unique pros and cons of each individual strategy. So when we talk about bullish strategies, this is when we talk about buying calls and selling puts. If you were to buy a call, just remember, anytime when you buy an option, it requires the stock to have a very large rally in order to profit. But what you have in exchange for that is limited risk. So if the trade goes against you, you know exactly how much you can potentially lose. Same thing for buying a put. It just requires a large decline in order to profit, but it gives you limited risk. On the flip side, if you were to sell a put option or to sell a call option, both of these are very forgiving strategies. So you can get the directional view right, you can get the directional view slightly wrong and still be profitable. But on the flip side, both strategies have higher risk potential. So really what you learn here is that options give you the ability to shift risk and reward. Unlike a stock where the risk to reward is symmetrical, if the stock goes up by $1, you make $1. If it goes down by $1, you lose $1. When you trade options, you have the choice of shifting risk and rewards around. If you think the stock's going to make a big move higher, well, you should think about buying call options. If you think the stock's going to make a little bit move higher, you should look at selling put options because it's more forgiving, right? And also by buying a call option, if the stock doesn't make a big move, you'll still lose money on that trade. So it's just about finding the strategy that matches your outlook rather than saying what's the best possible strategy, because you're going to have different stocks with different outlooks. Some stocks you think the stock's going to make a big move. Other stocks you think it's going to make a small move. Pick the strategy that suits your market outlooks rather than saying which is the best strategy and trying to apply the same strategy to every single scenario, because that's when you're going to underperform the broader markets. And I hope for those of you that are new, or for those of you that are learning how to trade options, that this inspires you to take a look at more complex option strategies, because what we learned here today is just the starting point. It's just the building blocks. This is not the end of the road, because when you trade more complex strategies, you can actually combine the best of both worlds. You can have limited risk and still have forgiving strategies. And that's where we look at debit spreads. That's where we look at credit spreads. That's your first step into combining strategies and getting kind of the best of both worlds. Or you can actually look at more even complex strategies like diagonals and calendars that takes the step even further, right? So you want to get the best of both worlds, and then you want to optimize them even further. Well, that's what options allow you to do. But in order for you to step into the more complex worlds of advanced strategies, the most important thing is to understand these fundamental building blocks. If you can understand these fundamental building blocks, you will understand more complex strategies. So with that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of these option strategies, and just understanding how these strategies are constructed, so that as you look at those more complex strategies, you truly understand each component so that you can understand how a debit spread works, why it works a certain way. Those are the things that you're going to be able to take onto your next step in your learning experience. So with that, what I'm going to do is I'm going to open this up for Q&A here for a few minutes. There's a Q&A section at the bottom of your page. There's a chat window and a Q&A section. Please bring up your Q&A window, and I'll try to answer as many questions as I have time for here for today. Let's see. So Ismail, we currently allow index options. We're limited to NDX, NQX, and XND. So you can trade them, and all the options are there. So if you trade NDX, all of the options, the weeklies, the monthlies, the quarterlies, those are all there on NDX, NQX, and XND, which are the NASDAQ 100 index options. Instead of buying a call option on DAL, what happened if you sold the put? I think that was a bit premature because we covered that. Joe is saying DAL trends shows bearish. Why would one buy a $41 call? Joe, this was purely for educational purposes. This was not to say we're bullish on Delta. This was just to show you, if you were to buy a call, what that looks like. If you sold the call, what that looks like. Purely for educational purposes, not a directional play. Can you get out of a sold call or put it at any time prior to expiration? Really good question. So the question was, if you entered one of these contracts, right? So September $41 call, can you get out of it at any time? The answer is yes. Any option contract, whether you're a buyer, a seller, a call, or a put, it doesn't matter. All four strategies, once you're in, you can always get out. So it's just like buying a stock, right? If you buy a stock and you want to get out, you have to sell it. You just have to sell it on the open market for the current price in order to get out. Same thing for if you were to sell an option. If you want to get out, you have to buy it back at the open market or the price of the open market. And that buying back or that exit, if you will, could cause you to lose money on that trade. So you can always get out, but you may have to pay, you might have to get out at a loss, but you can always get out. Great question, Karun. Gene is saying, would you use a short-term put sale strategy to accumulate shares of solid companies, for example? Yes, Gene. So that's really the next step in taking what you've learned here and start applying them to strategies. So shorting a put is a strategy that you can use to buy stocks. So basically, when you sell a put option, it gives you the obligation to buy the stock at $41, but because you got paid $2.11, you can effectively own the stock for $38.89. So if the stock goes down to $40, you actually get another $1.11, if you will, of a discount on the stock purchase. So it is a great way to potentially purchase stocks at a discount. It's something that we do cover in one of my webinars on how to generate income in your portfolio using options. Can you clarify the term naked and unmarried? These are terms used when selling puts and selling calls. Yeah, so basically, whenever both of these strategies that I'm talking about here, selling a put and selling a call, these are both naked calls, meaning you're just selling the call and you're just selling the put and you don't have any other positions on. For example, if you were to buy 100 shares of the stock and then sell a call, well, that is what we call a covered call. And also if you were to buy a put while you own the stock, that's what we call the married put. So naked just means when you're selling any type of option and you don't have any other positions alongside of that. And then if you have other positions to effectively hedge your risk. So one of the ways that you can hedge a short call is to own 100 shares of the stock. Because if you own 100 shares of the stock and you sell a call, basically whatever you lose on the call as the stock keeps going higher and higher, you're going to make back because you own the stock itself. So the net that you have between the two is basically a flat position. That's what we call a covered call. So naked versus covered or married is really referring to whether or not the leg is linked to another position that may provide a hedge. If I sold puts and stock is staying slightly below strike, when does the time degradation run out and you need to just buy yourself out before time begins to work against you and drive up value? So Laura, Laura's asking a bit of a more advanced question, but the answer to your question is usually in the last 2 to 3 weeks. If you're around the strike price at about 2 to 3 weeks time, the time decay will accelerate, but you also start to have accelerated risk if the stock were to continue to drop. So we tend to find that the magic number is around 2 to 3 weeks out when the time decay or the risk of the option starts to accelerate and start to exceed the time decay that you actually have on the option. Why sometimes you make money before the break-even point? So great question, Mohammed. So in the examples that we've talked about, we've been talking about what if you hold them to expiration. But let's say the stock goes from let's say you buy this call option and the stock goes from $41 to $42 in a single day. So you haven't reached this profit, you haven't reached this number yet, but you have to reach this number by expiration. If let's say you reach just shy of this number prior to expiration, you can still find yourself profitable, but you're only profitable if you sell your option on the open market. So you don't have to reach this price in order to make a profit. You have to reach this price by expiration date to make a profit, but you can actually be profitable if the stock reaches perhaps shy of this target before expiration. So that is one of the, I didn't have enough time to get into all of that here today. That's a more advanced topic to talk about, which is what we call Greeks. We have to look at delta, which is how much money you make if the stock was to move higher. And then you have to look at how much money do you lose due to time decay. And when you factor into both, that gives you some idea as far as how much money you can make. But that's what the OptionsPlay tool is designed to do. So if we go back to Delta Airlines, and let's say I was to buy this September $41 call option, but let's say the stock reaches $43, let's just call it $43 relatively soon. Let's say it does in the next few days. As you can see, I can still make money on this trade if the stock was to rally substantially. It hasn't reached my break-even price, but it does it in a very short amount of time. You can take advantage of that and sell your option and make that type of profit. So it is possible to make money before the break-even point, but you have to do it if the stock makes a big move in a short amount of time. What's your philosophy regarding options far out of the money or deep in the money when buying or selling? This goes back to this idea of saying, one thing is better than the other. One thing is never better than the other, because I can guarantee you, if there was a specific strategy or a specific expiration or a specific strike price that was better than any other ones, then no one would ever trade anything else but the ones that are best. It all depends on what your outlook is, right? There are benefits, if you will, to out of the money, really far out of the money options. And that's they're really, really cheap, right? They are really, really inexpensive. But the flip side to it is that they have very low probability of success. It's like buying a lottery ticket. You pay very small amounts of money, you're risking very small, and you have an almost guaranteed probability of losing that $1 or $2 that you've paid. And then you have this very, very small probability of making a lot of money, right? Is that good or bad? No, it's not good or bad. It's just whether or not that's the risk profile you're looking for. On the very flip side of that, if you buy a truly in the money option, it's going to cost you a lot of money, but it has a much higher probability of success. Even if the stock goes against you, you can potentially still make money on that particular trade. So it's just a matter of what your risk profile looks like and what you're looking for. Do you want that lottery ticket type payoff, or do you want something that's a sure bet that's not going to pay you very much, even if you're right? So one is not better than the other. It's just a matter of understanding the spectrum of one end of the spectrum to the other, and understand where on that spectrum you want to be in terms of your risk profile. If I sell puts and calls and get a credit for it, can you get out of it prior to expiration? Yes, all options you can get out. It's just that you have to get out at the open market. So if you have to get out and you have to take a loss, you can get out, but you have to take that loss. What causes an option contract to be exercised by the broker? So the broker isn't the person who exercises the contract. It's the buyer of the contract who exercises the contract. Now, your broker does assign assignments in theory randomly. They're supposed to assign it randomly. The OCC randomly selects brokers, and brokers randomly select accounts to get exercised. So if someone chooses to exercise a call or a put early prior to expiration, then you get the assignment if you are randomly chosen. So there are a few ways to prevent this, right? And those are some of the rules that we talk about when we actually talk about specific trading strategies. There are many ways to prevent early assignment. You can, not trade certain strategies, and you can avoid certain strike prices, and you can close out your trades at certain points to avoid early assignment. So even though it is randomly assigned, I will say in the past few years of trading credit spreads, which have short puts and short calls, I have never been assigned on a trade because of the rules that I have in place. So if you want to learn more about those, please take a look at some of our other videos on these specific strategies. When you sell a credit spread, can we sell one leg and then wait to buy the other leg? You can, but when you sell just a naked call or a put, the margin requirements are substantially different, right? So if I sell a credit spread, my margin requirement is relatively low, right? So if I sold a put credit spread, if I sold a put credit spread, as you can see, my max risk is $53. That's the total. That's all I have to post in order to get into the trade. But if I only put up the short leg, I have to post $3,940 in margin. So you go from $50 of cost to get into the trade to $4,000 of cost to get into the trade. So yes, technically you can, but most investors don't want to do that because of the extremely high margin requirement. Plus, not to mention, if you never get filled on your long leg and the stock starts to decline, you have a fair amount of risk. So you have a lot more risk, and you have to have a lot more money to get into the trade. In order to sell a call or put, I indeed have to have the money or the stock. Yes, so it depends on your option account. So some accounts are not able to sell naked calls or puts. I've been notified that after hours pins have dropped, so I haven't had a chance to take a look because I've been on this, call with you guys. So I'll take a look and we'll send out an appropriate adjustment if necessary on that particular trade. Please advise your comment on the wheel strategy as part of the wheel is bullish and part of the wheel is bearish. I'm not sure what you mean by part of the wheel is bullish and part of the wheel is bearish. A short put is bullish and a cover call is, I wouldn't say that a cover call is bearish. A cover call is definitely bullish because a cover call only makes money if the stock moves higher. A cover call does not make money if the stock moves lower. So I don't know quite what you mean by one is bearish because the cover call is certainly not bearish. What about longer term option strategies? Great question. I have a video just on that, Bill. You can look at me. You can look at our YouTube channel, which I will post a link here into the chat window. And I have a specific video on there for longer term investors. It's called Investing in the Long Term with Leap Options. You can find it on our YouTube channel. So please take a look. It is in the chat window that I just posted there. Do we have access to the presentation? Yes. So we will send anyone who's registered for this session, which if you're attending, you obviously are, a link to both the presentation as well as a link to the recording. Thanks, Tony. Thanks so much on this. I'm selling puts on names I want to own, but at a lower level. Your thoughts on the strategy? So James, if your question is is your question what I think about selling puts? If that's the case, it's one of my favorite strategies. I think it's a strategy that's very underutilized by a lot of investors. If your question is about at a lower level, that's where I encourage you to look at my selling put video on YouTube, because I talk about why you want to sell puts close to the current price of the stock. There's a reason that we don't sell puts that are significantly below the current price of the stock. I can understand a 50% profit target, but what about a loss? So the rule of thumb here is to cut your losses at about 50% loss on the particular trade. Well, I take that back. It depends on the strategy that you're trading, right? So if you're buying a call or buying a put, 50% loss, time to get out of the trade. If you're trading it at a credit, then you want to think of it as a percentage of your max gain. You want to think about how much can you potentially make, and then taking a stop loss based on a percentage of that. And it depends on the strategy that you're trading that determines that percentage. So if you're talking about a credit spread, we cut our losses at 100% of the max loss of the max gain. So Eric, when I refer to selling calls as not recommended, it does not include cover calls. I'm only referring to naked calls. Cover calls is something that we highly recommend for investors. Interesting in learning from you how to select between a credit versus debit spread. Great question, actually, Michael. I actually have a topic next month titled "Which one is better, credit or debit vertical spread?" So please look out for that session next month. I think it's the first or second week next month that I'm going to be doing that. Would you recommend closing one leg of a debit or credit spread if it moves significantly in your favor? So in theory, you can, but you should only ever close out the long leg. If you close out the short leg, you should always only close out the short leg, because if you close out the long leg, you're left with the short leg. That's going to significantly increase your margin requirement to keep that trade, and it's going to significantly change the risk structure of that trade. For an out of the money option that would close worthless, does that need to be closed? So I tend to tell investors, as a best practice, you should close your options before expiration. A lot of trades that you think are going to expire worthless may still get exercised, or that expire out of the money may still get exercised because of, something could happen Friday afternoon. Some macro event could come out, maybe some news comes out. And what happens is that once the option has ceased to trade at 4 p.m., as an option seller, you have nothing, there's nothing you can do. So if you find out 5 minutes after the close that something happened with that particular stock and the put buyer or the call buyer has the option, they have about, an hour or an hour and a half to exercise that call or put. I have seen investors who think that their calls are going to, or puts are going to expire worthless. They let it go, and some news comes out after the close. And next thing they know, they open up on Monday morning with a substantially different position than they thought that they were closing on Friday afternoon. So for those reasons, yes, the risk is low, but I think you should make a good habit of things that are going to expire worthless. Why not pay the extra penny or two, buy it back at the close, and not have to worry about that? I have seen people lose tens of thousands of dollars, on that mistake. I wouldn't call it a mistake, but just on that one unfortunate event that happens. Prevent that by just simply buying back those worthless options that you think are going to expire worthless. What info should be in my header when looking at positions? Well, I mean, P&L is certainly very important. Days to expiration, I think, is important. If you have an earnings flag, I think that is useful. But also having just an understanding of your delta and theta exposure would also be very helpful. I am an options retail investor, i.e. not trading stocks or futures. Okay. Do you have strategies around closing specific legs of multi-leg set of options? So no, we generally will close multi-leg trades both together. We usually don't break them up. There's not a strong advantage to breaking them up. If you are very strong on timing, you have a slight edge that you can get by breaking them up, but you also open yourself up to substantially more risk. So for those reasons, that's why I generally don't recommend breaking up a vertical spread or any type of complex strategy into its own individual legs. What happens if you own a call that's in the money at expiration? Well, your broker will automatically exercise that call or put for you, and you will effectively be long the stock on Monday morning. Yes, I will be doing more webinars on complex strategies. I do them all the time. I don't do iron condors because iron condors are just two credit spreads put together. And I do a lot of webinars on credit spreads. I can do one on iron condors, and I will do one in August, at the end of August, on what I call a rapid fire strategy session, where I'm just going to fire through all the strategies, what the best practices for each one, what are the rules for managing each trade, just so you have one webinar where you kind of have a consolidation of all the strategies in one. With that covers those questions that I have time for here today. I really appreciate everyone for taking the time. I hope that this was helpful in giving you a better understanding of these strategies and just the fundamental building blocks. I cannot stress enough, no matter how experienced you are, these fundamental building blocks are so important for you to understand in order for you to trade those more complex strategies effectively. And for those of you that are beginners, hopefully this gives you a good starting point, a good base to build your foundation on, and inspires you to take a look at more complex strategies so that you can start merging the best of both worlds of the things that you learned here today. Thank you so much, and I hope you guys have a great trading day.